The stock market's first half of 2022 was the worst in the previous 50 years. When you consider that the stock market is expected to make us approximately 9% every year on average, the reality that the market lost about 9% in just the month of September is absurd. We recently lost profits equal to a whole year in little under a month. However, despite popular belief, that is not the wildest tale. The biggest news right now is how scared investors are of the banks. The Federal Reserve has begun to increase interest rates, or what is known as the federal funds rate, and there is concern that they are about to break something, specifically Deutsche Bank and Credit Suisse. These two large banks are now the subject of whispers and speculations that they are about to fail, and their stock prices are starting to reflect this. The fact that both of these banks are designated as structurally important financial institutions, a fancy way of stating that they are too large to fail, is what makes this such a big concern, not just for the US but also globally. It is why some are comparing what occurred to Bear Stearns and Lehman Brothers in 2008 to the situations of these two firms. People speculate that this is essentially what's going on behind the scenes right now. Once more, even the CEO of Credit Suisse just stated that they are restructuring because they are at a difficult moment. Which is a little strange, because if you asked your friend how their life was going, and they said that they were preparing to restructure because it was at a critical point, he would likely be a little concerned about them. However, when a significant bank tells you that, that's when people start to panic. History doesn't always repeat itself, but it sometimes rhymes, which is why this well-known comment by Warren Buffett kind of captures what may be happening at the moment. The only way to find out who has been swimming naked is when the tide goes out, and what it implies is that we won't know who the people were who gambled with money they didn't have, took on too much debt, and used way too much leverage until the wave of money recedes. And when you add all of this to reports that the Bank of England just saved the UK economy from collapse, that the Russian economy is experiencing its own political unrest, and that the Chinese real estate market is experiencing yet another potential collapse, you have a very risky recipe for a future global recession. I want to be clear that I am not attempting to raise fear. This is not my forecast of what will happen. Instead, I'm attempting to describe the intricacy of everything that is occurring and the reasons why the markets are terrified so that we can better understand why this is happening and how it might affect us. Having said that, let's get straight to it. I hope all is good with you. Come for the money, stay for another banking catastrophe. Consequently, I'll first describe the historical context of the current situation before moving on to discuss Deutsche Bank and Credit Suisse. This year has seen the stock market decline for 3 consecutive quarters, previously occurring during the financial crisis of 2008. The Bureau of Economic Analysis recently released its most recent estimate for GDP in the second quarter. Remember that the GDP, which is reported every 3 months, is what determines the health and growth of the economy. The official recession begins when there are 2 consecutively negative GDP statistics, regardless what they are, as long as they are negative. Since the first quarter's GDP was negative 1.6% and the second quarter's was negative 0.6%, we already know that we are in what is known as a technical recession. There is a catch though, since the Bureau of Economic Analysis is likely to update the GDP figures 3 times for each time they publish them as they gather more information. Sometimes those figures increase, and we learn that there was no recession after all. Therefore, the Bureau of Economic Analysis recently announced their third and final estimate for the second quarter GDP, and that figure was negative 0.6%. Nothing has changed, confirming that we are still firmly embedded in what is known as a technical recession. People naturally blames inflation, which is why the Federal Reserve had to hike interest rates. But this is where things get interesting, because we might also put ourselves in a position where banks could face serious difficulties every time the Federal Reserve raises the federal funds rate, since bonds are a guaranteed way to earn a safe return on your money, and in today's market, that's everything. Whenever a company makes a profit, it will invest some of that money in the bond market. Companies will use their balance sheet, also known as their portfolio, which includes these bonds as collateral, to take down a loan, similar to how you might take out a loan using your home as collateral via a home equity loan. So with this money, companies will take a risk with it and invest it, and this cycle keeps repeating itself. But the issue is that at the moment, because the Federal Reserve is raising the federal funds rate, the value of their collateral, or their bonds prices, is plummeting and going down, and consequently, so are their stock prices. This could potentially expose them to margin calls, or to having their safety ratings reduced, which might force them to request a rescue from the government. And if that doesn't happen, that might result in a collapse, which would be horrible for everyone they funded as well as the company itself, which, in the case of a bank, is pretty much everyone. Now that is the situation. I've given you the general information about these two banks. Let me tell you how significant Deutsche Bank and Credit Suisse are to this, as As one of the top financial services firms in the world, Credit Suisse is a worldwide investment bank that was established in Switzerland. They are one among the top 10 banks that are regarded as being too large to fail, and according to the price-to-book ratio, their asset base is about equivalent to that of Lehman Brothers in 2008 before their collapse. Additionally, Credit Suisse has a very fascinating past. In 2012, the U.S. filed a lawsuit against them for marketing residential mortgage-backed securities that were riskier than Credit Suisse had estimated. They have been associated with countless litigation, controversies, and infractions throughout the years, including manipulating the forex market, tax fraud, and the most recent Archegos scandal, in which they lost $5.5 billion. Money laundering and assisting Russian oligarchs in financial asset concealment are the expenses that banks view as necessary for conducting business. However, these are also a few of the factors that have contributed to Credit Suisse shares declining more than 60% year-to-date and more than 81% overall. It's also the reason why investors are now comparing what's happening with Credit Suisse with what occurred with Lehman Brothers in 2008. Just to be clear, some of the analogies I'm about to present to you are at best based on anecdotal data, but they're still worth addressing because some of them are amusing. Similar to the first example, the head of the Credit Suisse board of directors happens to have the last name Lehman. It's interesting that Credit Suisse recently released a statement claiming to have a strong capital basis and ample liquidity. The Lehman Brothers CFO in September 2008 declared virtually exactly the same thing. "We currently have a strong capital position," they claimed. Although it wasn't, the price of so-called credit default swaps, which have already reached a price level last seen in 2009, is possibly the biggest piece of evidence now available against Credit Suisse. Purchasing credit default swaps, or CDS, is quite technical but is comparable to purchasing investment insurance. Now, if your investment proves to be correct, you will make a little less money, but if it fails and collapses, you will recover part of your investment's losses. Technically, the reason for this is that there is counterparty risk because what you are doing is purchasing treasuries, also known as government bonds. The market is protecting itself against a future Credit Suisse collapse by driving up the price of the CDS issued by that company, but the point is that the more risky an investment is seen to be, the more expensive that premium becomes. Exactly the same thing as taking on a Deutsche Bank, a different significant bank. They are enormous, with a base of assets that exceeds that of Lehman Brothers in 2008, in addition to being recognized as a bank that is too big to fail. Currently, its stock price is down over 83% overall, and 42% so far this year. They have a highly colorful past that includes decades of deception, violations of investor protection laws, manipulation of interest rate benchmarks, tax offenses, banking offenses, and on and on. That is the history of these two banks, their size, and the significance of their existence. Assets totaling $1.5 trillion are managed by Credit Suisse, while $1.3 trillion are handled by Deutsche Bank. Together, their assets under management come to almost $2.8 trillion, or about 4 times what Lehman Brothers had at its peak before going bankrupt. Additionally, Deutsche Bank has derivative assets valued at nearly $47 trillion. If that bank fails, the entire system fails. This is due to a phenomenon known as the contagion effect. It is precisely what it sounds like, a contagious impact. We already saw this happen in the cryptocurrency space earlier this year when Three Arrows Capital failed, which led to Terra Luna, which led to Celsius, which led to Voyager, and everyone else failing. The difference is that Lehman Brothers actually fell when they were selling these toxic insurances and CDS that they could not recover their investments from. If not for the government intervening and saving them, all of the other institutions would have also failed. You can also see the cost of these kinds of insurances because of this. Specifically, the value of the 5-year CDS increases because, according to market wisdom, the market is attempting to safeguard itself against a potential collapse. That's also the reason why the dollar will probably keep becoming stronger, and the stock market will probably continue to be more volatile. All of this exactly aligns with Morgan Stanley's study, which found that every time the dollar reached a peak, an economic recession, bubble, or crisis also occurred. Now, I don't mean to imply that 2008 will happen once more. None of this is a prediction on my part because I don't know how the market will behave. I'm merely attempting to comprehend how complicated this is and what the stock market is concerned about. Personally, it makes sense to continue investing daily using the dollar cost average method in the stock market. However, that's just me. I have the time because I'm younger and the market has time to recover. I can picture myself if I were older and considering retirement. it would be a more difficult decision, which is why it is crucial to start saving and investing as early as possible. This will give you enough time to recover if something similar were to occur when you are older. As always, I would love to hear your opinions regarding everything that is happening since, despite the fact that it is still speculative, it is still quite fascinating. In the meantime, enjoy the rest of your day. If you haven't done so already, hit the like and subscribe buttons.